So buying a home in 2025 feels impossible for a lot of people. Prices are up, interest rates are unpredictable, but if I told you there's still a 0% down option, that's still available, and it's called a USDA loan. It's a government loan, and it gives you an option for a lot lower monthly payment, and it's also a lot cheaper than FHA and conventional, but most people assume that they don't qualify. So by the end of this video, you're going to know exactly everything you need to know for a USDA loan, who qualifies, and also how to avoid any costly mistakes. Because skipping out on this loan program could cost you thousands of dollars in a down payment, or even worse, could miss out on the home that you could have owned this year. And here are the overall benefits. So a USDA loan is one of the few mortgage programs out there besides going VA, which is only for military and veterans, that offer 0% down. So that means there's no down payment required. You're not having to go get a grant program or a down payment assistant program because, again, there's no down payment that's required up front. You're also going to get a lower interest rate when compared with going to like a FHA or conventional loan, and you're also going to get a lot lower annual fee, which is very similar to mortgage insurance on an FHA or conventional loan. It's a lot lower on a USDA loan. And the whole idea of this mortgage program is designed by the government to help with home affordability. Now, a lot of people think that this loan is only for first-time homebuyers, and that's not true. You do not have to be a first-time homebuyer in order to get this program. And a lot of people think that it's only for like farm areas or for rural areas. Again, that's not the case. It's how USDA works is it's based on population density. So you might be surprised that areas within 20 to 30 minutes of you might qualify for a USDA loan. And that's the problem with this loan program. A lot of people there's so many misconceptions, there's so much confusion. And so a lot of buyers end up missing out on this great mortgage program because they don't understand all the details. Now let's go over in detail what a USDA loan really is. So a USDA loan, it's a government-backed loan, and it was designed and created in order to help boost home affordability, which has been a common issue throughout our history and especially right now. So here's how it works. So the USDA, they're the ones that actually sets the rules. So they're the ones that sets the income requirements, they're the ones that sets the property and area restrictions. Pretty much anything when it comes to the loan structure, it comes from USDA itself. Now, the USDA is then offered by approved lenders, and the lenders are there to really handle the process. So they're the ones that's going to get you through the application process, the underwriting, and get you to the closing table. Now, the reason why lenders are able to offer 0% down and lower interest rate is because the USDA is actually insuring the loan. And that's why you're able to get a lot lower interest rate when it comes to FHA and conventional loans. Now, you want to make sure, it's very important that you work with someone that is experienced and knows all the guidelines when it comes to USDA, because there's a lot of restriction, there's a lot of guidelines. And if you go to just a big bank, that doesn't mean that you're automatically going to get a loan officer that knows that this type of loan, how it works. So you want to make sure, again, that you work with someone that's experienced and knowledgeable with this type of loan. But qualifying for this loan is not enough, and the property itself needs to qualify. In regards to USDA, they have very strict qualification when it comes to this. Now, before we get into that, make sure you hit that subscribe button if you're going to buy a house in 2025. So USDA loans are limited homes in eligible rural areas, but that doesn't mean farmland or remote living. It simply just means areas with populations of 35,000 or less. Now, most suburban communities, small towns, or just outside of major cities actually qualify. And you can check your eligibility with the USDA actually online. So anything in orange is going to be ineligible. Anything outside of orange is going to be eligible. Now, you want to make sure that a lot of people just type in the city name instead of the exact property address, and this gives inaccurate results and can make you think that a property doesn't qualify when it actually does. So here's how you can use this. So if you're house hunting in an expensive area, just like Orlando, Tampa, Charlotte, look just 15 to 30 minutes outside the city. Places like Claremont, St. Cloud, or Belmont, you'll often find USDA approved neighborhoods with new homes, lower property taxes, and smaller payments, all within 0% down. So the biggest attraction of a USDA loan is the 0% for the down payment. So unlike FHA, which is 3.5%, or conventional, which is 3 to 5%, USDA truly requires no down payment at all, and it's not just a grant or down payment assistant programs. So a lot of people assume that 0% downs means zero cash to close, and you'll still have closing costs like title fees, insurance, taxes, and other lender charges. So what you'll want to do is you can combine your USDA loan with a seller credit or lender credits, and you can often cover your closing costs, meaning you could buy a home with little to no money out of pocket. And I've had clients bring $0 to the closing table, and even some got a refund at closing because of tax credit and other seller contributions as well. But if you skip the next step, you could be shocked by your total closed cost at closing. So let's break down those next. So even with 0% down, you still need to pay closing costs. And again, it's usually 3 to 5% of the purchase price. And this includes lender fees, title works, recording fees, homeowners insurance, taxes, and your appraisal. Now, a big common mistake a lot of people make is thinking that your lender fees are only the total cost, but closing costs include third-party fees that every buyer pays, no matter what lender they use. So what you want to do is you want to make sure that you know these costs up front before you go under contract, so you know what to expect. So you can also then ask the seller to cover this on your behalf, or even to do like a rate credit to offset some of those costs. And speaking of seller credits, most people don't realize how powerful they can be for the USDA buyer, so let's cover that next. So USDA allows sellers to contribute up to 6% of the home's purchase price towards your closing costs. And that can easily wipe out most, if not all, of your upfront expenses. Now, what you want to do is you don't want to ask for too much in a competitive market, because that can make your offer a lot less appealing to sellers. So here's how you can do this. You want to negotiate smart. So instead of asking for the full 6%, maybe ask for 1 to 3% to keep your offer strong. Or if the home appraises above the sales price, you can roll into your closing costs into your loan so that you only have to bring $0 to the closing table. But before you celebrate, your lender still needs to verify where every dollar has came from, and this is where many loans get delayed. It's fine, I'm recording. So even with 0% down, lenders must verify where your funds for closing comes from. So you can either use your bank statements, they'll ask for your last 2 months, last 60 days. If you're using a 401k or retirement account, they're going to ask for your withdrawals from that. If you use gift funds for family, they're going to ask for the family's bank statements to make sure there's no large deposits in that. And they'll also ask for a gift letter as well. Now, here's the thing. Depositing large amounts of cash and assuming that the lender won't notice any big deposit must be sourced, or it can't be used. So you want to make sure that you keep your finances clean 60 days before applying. Avoid moving money between accounts, and save any documentation for large deposits. This keeps your loan moving fast with no underwriting delays. Now let's talk about one of the biggest factors that determines your approval, which is your credit score. So USDA loans are surprisingly flexible with credit, and really the minimum credit score for faster approvals for your condition is going to be a 645 or higher, because that is a 645 credit score that allows your file to run through what's called USDA's automatic system, which will give an accept with that credit score. Now, here's the thing. Many buyers assume that if they hit the 645 mark, then they're guaranteed to be approved, but credit score is really only one piece of the puzzle. Your debt, your income, and really your overall profile still needs to make sense to the system. So if you're below a 645, what you want to do is spend a few weeks improving your credit score before applying. Pay down revolving credit under 30%, don't open any new accounts, and double check your credit report for any errors, because even a 20-point boost can drop your rate and move you from a manual to an automated approval, saving you both time and money. But a good score won't erase your past. So if you had a foreclosure, bankruptcy, or short sale, these next steps determine how long you'll have to wait before you can buy a house. So if you've had major financial setbacks in the past, USDA has specific waiting periods before you can qualify again. So if you had a foreclosure or short sale, the waiting period is 3 years. If you've had a Chapter 7 bankruptcy, you'll have to wait 3 years from discharge. If you've had a Chapter 13 bankruptcy, then you'll have to make 12 months of on-time payments and get court approval. Now, if you end up applying too soon, USDA will verify those dates, and even if you're a couple of months early, your application will automatically be denied. And if you're still within your waiting period, use that time wisely. Start rebuilding your credit, save for reserves, and get pre-qualified early so you know your exact time frame for reapproval. So now that we covered credit, now let's talk about mortgage insurance. So every USDA loan includes 2 small mortgage insurance fees. Number 1, you have a 1% upfront fee that gets added to the loan amount. Number 2, you have a 0.35% annual fee that's built into your monthly payment. And these fees are designed to protect the program so it can still continue to offer 0% down loans nationwide. Now, a lot of people compare this to FHA and they think it's the same, but actually FHA's insurance is more expensive. You have a 1.75 upfront and a 0.55 annually, so USDA saves you hundreds of dollars per year. Now, because USDA's insurance is lower over 30 years, that difference could mean over $15,000 in savings. So now that you know how payments are structured, now let's talk about how lenders actually calculate what you can afford, because the next number controls your entire approval. So your debt to income ratio determines how much home that you qualify. A lender compares your monthly debts like credit cards, car loans, student loans, plus your new mortgage payment against your gross monthly income. So what they'll do is they'll look at your what's called your back-end debt to income ratio, which is going to be maxed at 44%. This is all of your housing plus all of your monthly debt added up. So what you want to do is, the common mistake is focusing on only what you qualify for instead of what you can comfortably afford. So just because you get approved for a $2,800 a month doesn't mean that that fits your lifestyle. So you want to really use your pre-approval as a ceiling, not really just a target. So if you can, try to stay 10 to 15% below your max debt to income ratio, and you'll have a lot more breathing room, easier underwriting, and a lot more smoother approval. So USDA homes must be safe, sound, and pretty much in move-in ready condition. So that means there's no broken windows, no roof leaks, exposed wiring, or structural issues. And the home doesn't have to be new, but it must meet all health and safety standards. Now, a big common mistake is falling in love with a fixer-upper that doesn't meet those standards. USDA won't close on a home that needs major repairs before move-in. So what you want to do is, if you can, target newer homes or recently updated properties. They'll pass the appraisal faster, reduce repairs costs, and make your closing a lot smoother. So an appraisal really confirms two things. Number one is value, that the home is worth really what you're paying. Number two is condition, that it meets USDA's health and safety standards. Now, a big mistake I see a lot of people making is they assume that small issues won't matter. Even peeling paint, broken handrails, or missing certain outlets can cause delays. So you want to make sure that you ask your agent to negotiate these repairs up front or request the seller to fix these minor issues before you end up closing, to make sure that you're not wasting any times or that they're not going to fix it when it comes to that. So now that you know how the home gets approved, now let's look at how your income and employment factor into your own approval. The USDA requires stable income for the past 2 years, but it doesn't have to be from the same job. They'll count full-time work, part-time work, self-employment, and even retirement and Social Security work. But here's where a lot of people get tripped up, is they forget that USDA counts household income, not just borrowers on the loan. So everyone 18 or older in the home with income must be included in the total. So what you want to do is you want to go to the USDA Rural Development website and find the income and property eligibility section. You're going to enter your county and household size, and you'll see the limits. And then you'll be able to know exactly whether your income is within range, and if you're just over, you can plan deductions or adjust your budget. But here's the trick. You want to make sure that you ask your loan officer to send you that county limit link in your pre-approval, so that then you'll always have it on hand when you're browsing listings. So if your student loans are in an income-driven repayment plan, the USDA uses the actual payment that's on your credit report. But if your payment is $0 or deferred, then the lender must count 0.5% of your total loan balance as your monthly payment. So if you're not enrolling in an IDR payment plan before applying, a $0 payment will inflate your debt to income ratio and reduce your approval amount. So before you apply, contact your loan servicer to get on an IDR payment plan. This keeps your calculated payment loan and can increase your buying power. So you want to apply with a USDA approved lender like myself. And what we'll do is, number one, we're going to review your numbers. We'll go over your rate, monthly payment, and your total cost up front. Then we'll get you pre-approved so that you can start shopping for homes really immediately. And a big common issue is waiting until you find a home to apply, because by then you're rushing to get paperwork while other buyers are already out there making offers. So you want to get pre-approved early. You'll know your exact price range, your eligibility area, and your monthly payment before you ever walk into a showing. And if you're planning to buy a house and you want to know exactly how much is your buying power, click on the link in the description, schedule a call, and I'll be in touch.